In our next presentation, our supply and demand session is titled Coffee Fundamentals, Changing Paradigms. And please welcome Mr. Pavan Adarsh. He will address key issues such as the increasing frequency of weather-related events, the uncertainty surrounding demand and inventories, as well the shift of supply and demand towards Brazil, and the disruption of historical Robusta terminal prices, among other important topics. Please give him a warm welcome.
This is forward and backward. Thank you. Hello all. Thank you for being here. Thank you, Cinta Cafe, for hosting me, and thank you, Noalia, for presenting me with this opportunity. A colleague of mine warned me that if the presentation is going to be more than 20 minutes, you're going to lose your audience. I unfortunately don't have any magic tricks up my sleeve to keep you interested, but I do have some very exciting coffee charts. And hopefully through these charts, I want to get you all thinking and see how different the current environment in coffee is compared to what we know, let's say a few years ago. The way, just to have some structure, I'm going to probably put all these charts into the known segments of, let's say, supply, demand, stocks, and probably a little outside of that, which is your macro funds. But the intent is to really show you how different the market is today and what our take and our perspective is with regards to the current environment and the implications of that in the future. A quick disclaimer. I don't like showing, you don't like reading, so yeah. So before I get started on some of the charts on supply, of course, a lot of things have really changed in terms of the supply environment of coffee. But the one thing that really stands out to me is the confidence, or rather the lack of confidence in the coffee supply. As a case in point, if you just look at the Brazil Arabica crop trend, our big boy whom we all depend on for the supply, it's been pretty steady. The trend has been really steady. Of course, there've been on and off cycles, but we are all sort of used to it. But the past few years have been very different. In fact, if you just look at the 25-26 number, that's really the fifth consecutive crop where we had a kind of a weather issue. What is also interesting is we all are familiar with frost, dryness. These are all familiar areas. We do make crop revisions. As an analyst, I have confidently made some revisions when such weather events occur. But this time, especially in the recent times, we've seen very high temperatures, which are probably very difficult to estimate. To be honest with you, to have a good handle of how much the damage can be or the negative impact can be from high temperatures, you'll have to really wait for the harvesting. So in some sense, the uncertainty has really increased until the harvest really happens. Even outside of Brazil, the El Nino, La Nina impacts, they have been really growing in terms of the frequency and the severity. The chart there shows the probability of El Nino or La Nina as a trend, and you can see that from about 50% several decades ago, we're now really talking about 70%. What that really says is, out of every 10 months, 7 months, you're bound to see a La Nina or an El Nino event. And in fact, even as we speak, November, December, January, we have a weak La Nina event. We're already seeing that in Costa Rica with all the rainfall. But that has led to harvesting delays, if not crop reduction. We've seen that happen in the Central American regions. We're also witnessing that across the globe in Vietnam. So really, that frequency has also brought in an added uncertainty to the whole balance sheet and the crop metrics. Now, the supply uncertainty, unfortunately for us, doesn't stop really there. We have a new kid down the block. the logistics. To me, post COVID, something significantly has changed in the very regime of the sea freight. The volatility, I didn't even care to really put a very long chart here because really that's been flatlined. All that has happened on the freight, anything interesting that has happened is really post COVID. And the volatility in terms of freight rates, the transit times, port congestions, port strikes, I mean, everything has really skyrocketed, and that has really added a huge layer of uncertainty to the entire supply chain. I mean, if you think about it, again, just to get the math easy, globally, we as coffee industry export, let's say, 120 million bags. And on a monthly basis, that's like 10 million bags of coffee. And if you have 1 month delay in your transit time, all that coffee is going to really stock up as in transit stock or on the sea. And in some sense, that really creates an artificial deficit. It's not really there on the balance sheets. The balance sheets are not going to get you or tell you that there is such a big deficit. The market is going to behave as if there's a 10 million bag deficit because while the coffee has been exported, it has never reached the destination. And I think we do have some metrics to validate this theory. So the purple line there is really the exports. That has completely skyrocketed. In fact, the 23-24 season was the highest on record in terms of the global coffee exports. And even in that, 5 out of the 12 months were either close to record or a record on the global exports. But if you look at the import number, which is the orange line, it's not really there. I mean, there's hardly any pickup in the import. So that gap between the export and import is essentially that coffee that has been stuck either in the transit or at the ports. And even in Brazil, there's been close to 2.5 million bags of coffee that has been stuck at the port. So in some sense, there is this supply uncertainty which has been brought about by both the weather as well as the logistical challenges. So are we saying that there is a structural problem in terms of the supply for coffee? I really don't think so. I mean, if you just look at the coffee producer prices, the prices have enabled the coffee farmers to have record prices. I understand that the production costs have really increased, but trust me, if I were to replace this chart with a margin chart, it's not going to be any different. So the market has done all it can in terms of providing the best kind of crop potential in the future. So on a crop potential basis, the supply has really expanded. However, the market is not really currently focused on the potential, but what can really be the availability. And because there is a significant lack of confidence in that, the market prices are way more richer than the potential of the crops. Now, one way to combat the, let's say, the weather uncertainty is to have sizable pockets of production across the globe, which is really diversification of supply. But unfortunately, as an industry, we have really moved in the opposite direction, where we've been concentrating the supply. As we speak today, the top 4 origins, I don't need to name them, they account to around 70% of the entire coffee production. Now that definitely brings in an additional layer of uncertainty because you have a concentrated pack and you have increasing weather uncertainties that really amplifies the already uncertain world of supply for coffee. So in a nutshell, what are we saying? We're saying that there is potential. The market has done all it can. In fact, to be honest with you, I don't know if in the earlier chart, if you have a normal weather situation, 25-26 is sort of almost done with. Let's say for 26-27, Brazil production can certainly be 55 or maybe even more if you have really the good weather, just given how good the producer prices are. But the bigger challenge is really to build that confidence in the market, which has completely been shattered because of the consistent weather incidents, and the logistical challenges. Now, coming to demand, this is really no less interesting. Particularly, again, COVID seems to be having a sort of pivot in several industries, and we are no exception. Let's say a decade ago, this is probably the most boring exercise for an analyst because the coffee demand hardly moved. It has been very, very consistent. And after COVID, something has changed. We could, I mean, this is, by the way, USDA. These are not our numbers. Our numbers are even more softer. So you'll see even more flatlining after COVID. But in essence, I think most of the reports indicate that there has been a significant change in the trend of coffee consumption post-COVID. Now, we'll try and address some of the issues. Some of them are pretty evident. Obviously, all of us have experienced a significant dip in the out-of-home consumption, which has not fully recovered to the, let's say, the baseline. We all know that post that we had very high interest rates, which is a big burden on the consumer wallets. And then you have high prices. So we know some of the reasons. So we'll try and probably show those in the coming charts. But before that, I'll just take a small detour and probably highlight the importance of what Conilon can do in the future, especially around the demand dynamics. So this chart is the orange line is really the Conilon proportion in the internal market of Brazil. And the purple line is the premium of low grade over Conilon within the internal market of Brazil. The reason for why I'm showing you this chart is the flexibility of blend changes within Brazil has increased tremendously. As a case in point, a few years ago, when the low-grade premiums were much richer than Conilon, that is, Conilon was very cheap, we all felt that the incorporation of Conilon could really be 60, 65%, but we ended up working with an 80, 85% in the blends. And now, with the things changing around, while I'm working with a 50% share of Conilon in the blends, the real-time data is almost probably close to 20 or even lower. So that's the kind of swing factor that Conilon can bring into the overall global coffee dynamics. And just to give a little bit of context, when I'm talking Brazil, it's not just a big producer, but it's also a big consumer. So really 23 million bags, and then a 10% swing in this can really mean moving 2 to 2.5 million bags of coffee from Robusta to Arabica or from Arabica to Robusta. Now, Conilon's story doesn't really stop there. It did take the export market by storm. I think some of the charts have already been shown earlier, but as a share, it has tremendously increased. One big reason for this, at least according to us, is that the demand dynamics have really pivoted from being more of a premium offering to more of a value offering, especially in this current environment. So the cheapest coffee, in fact, all coffee had to sort of compete on price. Beyond all the specs, it was a price on which they had to compete. And Robusta, as such, had that intrinsic advantage of being the cheaper coffee. And at that time, with Vietnam, Indonesia not really available, and Conilon definitely cheaper, it really took the export market by storm. We do have some interesting data points to sort of validate this theory. This chart, it's almost like a proxy to the ARB, but it sort of normalizes the entire thing with the current coffee prices, which probably to me is the right way to look at it. It shows the premium of Arabica over Robusta. And in some sense, what this chart is telling you is the market doesn't want to differentiate between Arabica and Robusta. And as coffee players, I think all of us have experienced a bit of that in the recent times where, Vietnam was trading either equal to or probably richer than some of the Brazil Arabicas on a CIF basis. So this is a significant part that all of us have to consider in this current environment. And this becomes even more pronounced when you look at the current coffee prices. The current coffee prices historically are at the richest. Now, let me explain that. I know we've seen $3 coffees and all that, but if you look at the global coffee blend, it has a mix of both Arabica and Robusta, and on a weighted average basis, we are probably at the richest level right now. And in fact, I didn't even add the last few days of action on the market, then it's going to be even higher. And one last theme, which also to me looked very interesting, is really a soft undercurrent of efficiencies that's been setting into the demand side of things. This chart shows you, I mean, I tried to adjust the scale, so the orange line there is the roast and ground proportion of the overall coffee demand, thanks to Euromonitor. There has been a constant decline in the roast and ground, and most of that demand has really been picked up by the segments which are more efficient, like the single serves, the pods, the coffee beans which go into the machines. So in some sense, while the world may not really be maybe actually drinking the same number of cups of coffee, the amount of coffee that is generating those cups might actually be decreasing because of these efficiencies. So that's powerful, and to be honest, we need more data to validate that, but that's something that we want to seriously consider as we move ahead. So what do we essentially, very similar to the supply on the demand side of things, we're saying that post-COVID, the demand has been very soft. Conilon is not a cog in the wheel on the demand dynamic, it's probably the wheel itself as we move into the future. And the efficiency theory, let's say, can have some significant implications when we're trying to predict some of the future demands. With that, before I move into inventories, so far I've talked about supply, which has been sort of lower, but the demand has also been softer. So it doesn't seem to be causing a big problem on the balance sheet. You have a lower supply, yes, but you have a lower demand. But here is a real kicker, and I think it's really the inventories and the spot demand and supply that played the biggest part in the significant rally that we've seen in the last 12 to 14 months in coffee. So before we sort of understand the dynamics around this, I think we should, sort of look at the macro environment in particular. Interest rates have been very rich, not just coffee. I think across the asset classes, across different industries, they have felt the heat of really the cost of capital, the cost of funds. But for coffee, the whole thing has really amplified with the prices also being super rich. So you have a very high interest rate, and you also have a record high coffee price. So together, the cost of carrying coffee has been really punishing. And inevitably, or rather choicelessly, I think the roasters and several in the industry had to really shrink down on their inventories. And that brought about a dislocation between, let's say, the global coffee balance sheet that we are all used to and the destination balance sheet that we have to start looking into. This is the global coffee balance sheet. This is the stocks to use ratio. When I say stocks, global stocks, it includes the stocks at the origin, stocks in transit, stocks in the destination. It's the total coffee balance sheet. So that's not terrible, right? Because you have shrinking supply, yes, but you have also a shrinking demand. So in fact, it's sort of picking up as we move into 24, 25, 25, 26. But then, if you switch gears and actually look at the destination stocks to use, it tells you a very, very different story. A part of this is sort of understandable, like I've showed the interest rates, the punishing costs of holding coffee. I think that has led to some reduction in the inventory, but the logistical challenges also added on to it. With coffee not reaching the destinations in time, the destination stocks to use ratio actually fell down to very, very alarmingly low levels. And the roaster, who's actually pretty much sitting on very low inventory, had to sort of move the demand more nearby, which is in some sense, spot demand. Again, this is from the COT. I just converted the entire thing into the million bags. You can see that the overall inventory on the futures, which is very sort of a good proxy in some sense to the physical inventory, has gotten to very low levels and has stayed there for some time now. The issue with having low inventories is that it really drives that spot demand because the roaster cannot really eat into the inventory. Any demand that he needs is going to be very spot centered. And at the same time, we have the problem of lack of confidence in the supply of the coffee in on the spot side of things. So a combination of slow flows on the spot and high demand on the spot has really brought about a significant amount of big deficit, let's say, on the spot balance sheet. And while the terminal prices do reflect the overall S&D, the better job is really done by the, just a minute. Yeah, the better job is really done by the terminal spreads. And just like the terminal prices, I think the spreads in both Arabica and Robusta have really skyrocketed, which are essentially implying that there is a significant amount of spot deficit. Now, this is really the story. Yeah. So this is really the story which is very pertinent to today because the market is now entirely focused on the spot supply and demand and not the global supply and demand. And as a result of that, it brought with it some added complications. Now, if you step out of coffee and move into, let's say, the fund action, for the funds, investing in any asset is fairly simple. It's the return and the risk. So for coffee, when you take a look at the spreads on a return metric, you're really talking about 10% return for the funds to be long in coffee. Now, why would they be long in coffee just for the 10%? They would obviously try and gauge the risk, which is, a fall in the coffee prices. But then the current setup is giving them the confidence that the risk of a downside in the current market is very limited. Why? You have a roaster who is almost consistently participating in the market, providing that support on dip. You have a producer who is very well capitalized and he's not willing to sell in a hurry. So the whole setup is just giving this confidence to the funds to keep engaging on the long side because there's really no downside risk, and you sit on a long position and you're gaining 10% return just being long of coffee in be it Robusta or Arabica. And as a result, you can see the funds have sort of continued to add on to the positions and sort of stayed there for quite a bit of time. And you can also see some of the recent dynamics that are happening in the market, let's say in the last few days, where you had the EUDR-related uncertainty. The moment you have uncertainty around the EUDR, that immediately speaks to the spot demand. Once there is spot demand, the tightness of your spot supply and demand really becomes sharper, and the spreads go berserk. So in the past few days, the spreads also started rallying, and the moment the spreads rally, the funds get interested, and there's more fund addition into the coffee markets. And like I said, you do have problems not just on the crops, but on the flows. With no flows of coffee coming from centrals and Brazil, they're being very measured. There's no upside liquidity, and the market has really generated significant amount of volatility. Now, the regulatory changes are also going to be very significant because they do have a direct implication, probably not on the global balance sheet, but on the spot supply and demand. And that is really the theme of today. And the moment you have a delay or, let's say, rollout of the EUDR, then you do have an immediate implication on the spot demand, and that can really drive the prices quite volatile in the medium term. And to me, this is an area which needs to be closely watched, because you know regulations around responsibly sourced coffees is probably the futures. There can be many of such regulations come in. I mean, maybe not in the immediate term, but in the near future, and you can have those in different geographical pockets, and all of those can again have some significant implications. So, what are we trying to sort of summarize here? If you take a step back and look at all that I've really said, the traditional way of looking at coffee from a coffee balance sheet point of view and trying to gauge prices from there is probably not going to work in the current environment, because the market is entirely focused on something very different, which is really your spot supply and demand, where logistical challenges, EUDR related movements, the demand, the spot demand, which is again going to be almost perennial till the inventory is built. So all of these are going to probably play a bigger part than the balance sheet guidance itself. On a similar note, arbitrage, or let's say the demand dynamics, like I've indicated, is probably going to gear more towards the value than the premium, and that has significant implications to the overall arbitrage, let's say, for the coffee markets. And last of all, the certified inventory. I think all of us know differentials did, come to pretty low levels in several of the origins, if not on a regular basis, but periodically. But then there was no sign of any coffee buildup, certified inventory buildup. One big reason for that is, again, the spot demand. The demand from the roasters has been so strong that there has been no chance for the coffee to really get graded. And on the trade side of things, we were sort of forced to operate on a reasonably fat margin in order to really cover those punishingly high costs. So while you might have buying differentials at pretty cheap levels, the selling differentials do not really warrant a strong grading or a pickup in the certified inventories. So are we, in some sense, we are in this vicious pickle where you have the high interest rates, the logistical challenges, uh, you know, high capital, or let's say carry costs, all of that really driving a very, very tight spot supply and demand. And in a situation where you have a very lean roaster, that is leading to significantly richer spreads. Once there are spreads, the funds are engaging on the long side, further returns, because the certs are also not building, and you have high terminal prices as a result. And that's again really feeding into the high capital costs, and we are in this kind of a sort of a pickle. And it seems like, unfortunately, the solution to this is not within coffee but outside of it. So some of the factors that can really break this cycle are, maybe a change in the macro environment. So we do have one such change, with the US elections. So let's say we have uh, a change in the trajectory of the interest rates, then finally there can be the chance for the roasters to really pick up on the inventory, and that can really ease that spot supply and demand, spot tightness per se. But at the heart of it all, to me, I still feel that there is this lack of confidence which needs to be built in order for the prices to really reflect the global balance sheet. And for that, we at least probably need a full cycle where we see that the crop potentials are really reflected as actuals, and we see that there are less logistical problems, and the roasters get the confidence that yes, the coffee can now flow comfortably from the origin to destination without any hiccups. So, yes, we should ideally begin to see some relief on the prices if we break the cycle, but I don't think that relief will come in a big hurry, because there's going to be a chunky premium for that confidence, which will probably take a little bit of time. We need to have one or two big Brazil crops which are sort of in line with what has been forecast. We need to see clean logistics happen, and hopefully then the current prices will begin to reflect what the global balance sheet is showing, which is in a way, lower than where the current market is. So that's really my coffee story. I hope it added some value, and thank you again for being here, and thanks.